Good morning and welcome to this live stream session on the big issues facing the group risk sector. I'm joined by three experts from different corners of the market. Right opposite me is from Ellipse, we have the Chief Executive, Lee Lovett. To his left, we have Malcolm Robertson from LifeSearch and Damien Stancombe from Barnett Waddingham. So we've got experts from different areas, as I say. Some people who are maybe entering the market, such as Malcolm only recently. Damien's from a large consultancy, but not necessarily a group risk expert. But we're going to be looking at some of the big issues facing those who are either looking at the group risk market for the first time or the experts. That Lee can answer the questions of those who have been in the market for a very long time. Lee, over to you. First question that I do have is, growing the market and improving lives, we've basically found that the government's kicked into the long grass the idea that there's going to be anything coming from them with regards to expanding the market. They've told the industry maybe you could make group income protection a bit more straightforward, a bit more simple. Other than that, it's in the long grass. So where does the market go now to actually grow the market?
Yeah, good question, and very many thanks for hosting us here this morning, John. So yeah, the Improving Lives paper, I guess it was a bit of a false dawn because early on it looked as though Group IP was going to get quite a big profile, quite a high profile, and a number of the providers were pushing for financial incentives to try and encourage employers to take out IP. When the final roadmap paper came out, Group IP seemed to have been deprioritised a bit. I think it only got a couple of mentions in about a 90-page report. In terms of where the market goes, I personally wasn't a big fan of financial incentives. I don't think that was the answer in isolation, because that's effectively equivalent to just cutting rates. If we cut rates 5 or 10%, that wouldn't necessarily grow the market massively. So financial incentives for me on their own wouldn't do the trick anyway. I do think the important thing on that would have been the government endorsement or the implied government endorsement of giving a financial incentive. So I was much keener on that than I was on the financial incentive per se. In terms of where the market goes, I think we're in a position where, and to a large extent, the potential growth is in our hands and that of advisors like these guys here. I think we could make the product simpler. The government suggested in the paper that some product development was needed. I think some product undevelopment is needed. Just strip out some of the options. The options are great for the sophisticated existing market, but for new to market, and there's just too many options there. Some of the terminology is a bit confusing. We could probably make it a bit more plain English, and we're probably as guilty of that as some others. So I think some simplification of options, more use of plain English would be a healthy starting point.
Right. Malcolm, your firm, obviously you're strong in the individual protection market and the business protection market. It's been a relatively new area for you to come into the group risk sector. How has it been, and what more would you like to see to make your life easier?
Well, we started in the group protection market in 2015, and we've seen around 400% growth every year. That's from a standing start. It's telephone advice, and it's really new to market schemes we're focusing in that SME space, where there's 1.3 million firms out there with under 50 employees. So there's a big opportunity there. A lot of the providers have done some terrific work with their quoting systems. But where we find a lot of the cost is in the back end processing, the returning of application forms, the invoice payment, and then also completing the trust forms and chasing the clients to actually get that through and making sure it's returned within a 60 or 90 day period. So I guess the insurers have done an amount of good. I'd really love to see just that final tweak in the back end administration side of the process, which would certainly grow the market even more.
Right. And do you find that there's much variation in the ability of different providers to do an end-to-end process?
All of them need the application form, and they all need the signed direct debit. It's a scanned process that we'll pass over to them. But if there was that end-to-end journey, a totally digitalised journey, that would massively help us grow the market further.
Okay, Damien, if we could come to you.
Yeah, I mean, it's interesting because I've been in and out of what I would describe the risk protection, the health market over the course of the last 30 years. Barnett Waddingham, we've used the kind of risk aspect attached to DB pension schemes. So we've looked at, spouses, death and service and group life. I think where I'm coming from is really getting larger corporates to reimagine the benefit provision they have. 25 years plus, and as I say, the kind of structure of those products really haven't changed. Yet the workforce has, and it's as you say, simplifying it, repurposing it, and actually making it more joined up. And one of the fascinations I've found coming back into this area of the marketplace is that you still talk about risk, protection, and health as two kind of separate streams, where actually, we're talking about intervention, early diagnosis, etc., that should feed in or bleed across into that kind of risk marketplace. So I'm asking corporates to reimagine their spend and put it really in terms of the workforce they have now, the needs of that workforce. This idea of a generic 4 times death in service, that world's gone. So repurpose it, reimagine it, and as you say, for the product advisors to kind of do the due diligence on the kind of product suite and make sure it's fit for purpose.
Okay, Lee, do you want to come back on Malcolm's point there about the technology?
I guess my starting point was going to be, I'm tempted to say you're obviously working with the wrong providers, but maybe a bit harsh. But so I think the challenges you would have are that all of the providers are slightly different.
Yeah.
We would certainly claim to have a more digital process than most and very limited paper. We do need a signed application form, but that is the legal basis of the contract. So I think we can all understand that. And we do need a means of paying money. Outside of that, our process is all online. You can download policy documents from our document store and you'll get the statement of account very quickly within days, not weeks or months that you might be used to elsewhere. If there isn't an existing trust in place, you can use the Ellipse Master Trust. So I would like to think we've got most of those pieces of the equation in place. But for an advisor looking across the whole market, clearly you've got a mix of processes, some more digital than others. So I can understand some of those challenges.
When I'm thinking about the group risk market, I'm kind of relating it back to the business protection side. When you've got AIG that has an end-to-end process for business owners, or even for shareholder protection, when you need a trust, everything is online. And for us as the intermediary, around 50% of our business protection goes to AIG because they have that end-to-end process. So I know there's legal challenges, but every insurer has a different process or legal take on that. So I guess the challenge is there for the market to look at possibly the AIG process.
Yeah, but I think your business protection, key man, for me, are in that grey area between group and individual. Our proposition is clearly group, which is 2 or more employees.
Yep.
Business protection, key man are typically individual policies. So, but clearly they're individual policies for an employer.
Yes.
So, for us, key man, business assurance are in that grey area between group and individual. And absolutely, I understand that AIG have a strong business proposition. We don't play in that space specifically. We're providing group risks to 2 or more lives.
Okay, and if I can just remind viewers that under the screen you'll see a box there, and please do send us in your questions. We'd love to put them to our panellists live. Damien, coming on to GDPR, obviously I know people have been worrying about it. It feels like this year's Y2K.
Yeah.
Is it going to change the way you do your business?
Well, it's going to have to. I mean, the impact is, part of Barnett Wanningham as an administrator, it does feel as though we've been looking at GDPR for forever. It's took a huge amount of compliance and technology, time and effort, which has been basically sucked out doing business in the exterior world. So that's had a huge impact. It's delayed things that we would like to have done. In terms of, silly things like even marketing lists, we talked about this idea that it will shrink the connectivity, what we're trying to say to the external space, because effectively going out there and asking for permission to send things through people, I see it every day of the week with things popping up in my email. Yep. And I've now got to the stage where I'm cursory just going swipe right or left, whichever one it is. I don't use those things, so whichever way it is to delete them. There's just a plethora. I think the problem I see from the risk marketplace is that they seem to have been slower to the marketplace around how they see the issue of GDPR. We've got clients asking us, we've got our kind of set processes, and we've been kind of waiting, and I accept that Ellipse has been at the front of the queue in terms of coming to market and saying what's happening. Others we're still waiting to get a handle on.
Right. Malcolm?
Well, from LifeSearch's point of view, we partner with marketeers, so it's the Compare the Market, Money Supermarket, Lloyds Bank. They're the guys who are going to be getting the permission for us to be able to speak to the clients. So it's not necessarily an issue for us, but the small brokerage out there who are paying for client data, they have to know that it's where the permissions come from. So if it's been through 3 different channels, the responsibility is on them as the broker to actually understand the permissions, and if they don't, then there's big fines in place. So it's a problem for a lot of smaller firms who are buying client data.
Yeah, obviously those fines are rattling everybody's cages. Lee?
Yeah, I think so. So I guess my starting point is, as an individual, I completely agree with the principles behind GDPR around protecting people's data, because as some of the Facebook stuff recently has illustrated, maybe some of the controls are not as good as they should be. So at that level, I completely agree with it. In terms of what it's meant for us, I certainly can relate to some of Damien's comments. So for us, it's been a massive multi-dimensional project that's been running for about 9 months now. Whether it's changes in marketing distribution lists, so as you said, we're rebuilding ours from scratch, whether it's system changes to make sure the data's better protected, process changes, supplier contracts, terms of business agreements. So it cuts across many dimensions of our business. Clearly it's regulation, so it's not optional and negotiable. It's something we need to do. But what it has meant is stopped us doing other things. So we had a number of other projects that would have added direct value to our business in terms of either growth or efficiency, which would be our 2 main drivers for IT development. And essentially we've just had to put both of those on hold until later this year. What will it do to the market post GDPR go live on 25th of May? I hazard a guess the market will blissfully carry on as it did before, probably with a bit more protection in place for everyone, which is probably a good place to be. But I don't see it fundamentally changing the market.
But is it going to be hard for intermediaries and providers to actually reach out to new prospects? Because we're talking about growing the market, and obviously one of the ways you can do that is by sending them things. So
for us, like a lot of other firms, I'm sure, we had a fairly comprehensive mailing list that we were happily emailing all our stuff to on a weekly or monthly basis. So with GDPR, we're now rebuilding that list from scratch, where everyone has to consciously opt in rather than just opting out as in the past. So I feel sure that at the end of that process, so first of all, we've had some very good responses on that. So the take-up so far has been surprisingly good, which is pleasing for us. I feel sure at the end of it, we'll end up with probably a shorter mailing list. But the key thing is it's people who have consciously said, we want to receive your materials. So maybe from a quantity point of view, not as long, but from a quality point of view, a more interested, focused audience would be good for us.
Sure. A question we just add in from the audience. Can we come up with a better name than Group Income Protection?
Probably. I guess the question is, would it make any difference? So, when you've been around for a while, you remember things like PHI, and I do remember, as I'm sure Damien may do, the change from permanent health insurance to income protection, which clearly was going to dramatically change the market. And in reality, it made no difference at all, other than create more confusion because it's another product name. And did that used to be PHI?
LTD as well was in there.
And you've got American variants, long-term disability. You've got sick pay, which we use as our brand name because we think that's more reflective. So personal view, I think the market could expend a whole pile of energy and money on changing the name and make no difference at all to business.
Yeah, having just come out of a pensions background, the debate of whether the word pension is right or wrong, I could do without going into this space, trying to rebrand the whole thing again.
Yeah.
It's about communicating to the members the value of what it is, not the name.
Windscale and Sellafield springs
Well,
to mind.
yeah.
And another question here, actually, given the state, and maybe this one for you, Lee, given the state of bond markets, which way will premiums go over the next year?
I haven't got my crystal ball with me. We're entering
we've been in a low interest rate environment for quite a long time.
I think whether it's bonds or yields or gilts, or yields from long-term interest rates, the general trend on all of those seems to be upwards. For the products that are interest rate sensitive, like income protection, if everything else stayed the same, if interest rates go up, premium rates should go down. of course, not everything always stays the same in the market. You know, there's other drivers of premium rates, claims experience, to name one. So I couldn't confidently predict that rates will go down as a result. I don't think interest rates will really affect critical illness or in particular group life rates. It's a relatively small part of the pricing equation.
Okay.
It might affect income protection, and it might affect the death in service pension or segment of the group life market, because that's also quite sensitive to interest rates.
Yeah.
So,
Which brings us on to actually that's a part of the market that seems to have been actually remarkably resilient, shrinking but still resilient. The Group Watch report showed there's quite a rump there. Are you surprised by that?
yeah, so I think probably 5 years ago, it was the end of the death and service pension market, and it was all going to fade away very quickly. But you're right, it's been fairly resilient. The volume of premium in that segment hasn't really changed materially. I think it's dropped about 20 million over a 5-year period. So it's still at about 170 million, something like that. So it's still a substantial segment of the market, about 15%, something like that. Underlying that, I guess the key question is, well, why has it been resilient? And these guys might have a slightly better idea, because obviously they're in dialogue with the employers who might actually have the schemes in place. I'm sure there's been some reluctance for employers to change and upset their employees by removing benefits.
I think you're right. It's the trustees. The nervousness has always seemed to be taking away something.
Yeah.
And as you say, trustees are nervous of upsetting the apple cart. It's an add-on really to the main thing, the main show, which is the pension. So no, I agree with you. We've talked about this over the last 10 years about basically the idea that it would, well, what's the point? A multiple is far more tangible, but you get to the rump and the rump will stay.
And that'll just slowly erode as the defined benefit sector
slowly but steadily.
I think what you're probably seeing with those is the number of members covered in that are reducing by number as people leave, and they're probably close to new entrants, a lot of them, but obviously they're ageing at the same time, so that probably offsets the people leaving in terms of the premium volume.
Yeah.
Yeah.
And then Fit for Work came along, again another thing that we talked about a lot in the sector, had great hopes for. And it's lasted, what was it, a year and a half, possibly 2 years?
Yeah, it's probably lasted a bit longer than that, because I did a few trials in sort of local regions in the UK, and now it's been withdrawn about 3 weeks ago. So I guess the Fit for Work initiative is effectively the government version of early intervention on group IP. So after someone's been off sick for 4 weeks or whatever, they get support from medical experts. So the principle is great. My understanding is that the usage of it was incredibly poor. I saw a stat that something like 70% of GPs had never referred anyone to Fit for Work, which maybe tells something in itself. Will it have any impact on our market? No, I don't think so, because I think the vast majority of people were blissfully unaware of it anyway. It's a shame, because it feels like the right thing to do. And certainly for us, early intervention is absolutely key in terms of running profitable group IP, but also providing the right support for people in the early stages of absence. So I think it's a really valuable support service, but it's a bit disappointing if the government can't make it work. But that's frankly what's happened.
Yeah. Damien?
No, I mean, I think Laura, who's probably listening to this, it's said from day one that it wouldn't work. And she feels, I mean, like you do, it was a great idea. It's just the practicality of implementation. And early intervention means early intervention. If you've then suddenly got a waiting list the other side, it kind of negates the purpose. My interest is that, we talk about the government not being interested in the workplace and trying to gerrymander what's happening. We've seen in pensions, just wait. They've moved it from the public sector, and it will land right back into the workplace, and for organisations to be picking up the cost to do all this.
You see that? But wasn't that the Improving Lives was the opportunity to do that?
But it didn't work. So, it doesn't mean that they're not going to have another stab at the cherry somewhere along the line. Whether it's through compulsion or whatever it may well be, something will happen, because the NHS can't deal with it. So it's going to move it into where you are, into the workplace.
Well, that brings us to a question in from Ian. Thank you for that. Would you like to see compulsory group income protection for companies in the same way workplace pensions are now compulsory, especially given the strain on state welfare benefits? So it sounds like you're expecting it to happen. Malcolm, would you like to see it?
I think it has to be a choice. to make it compulsory, it's an add-on to a conversation that we'll have with our customers. If you make it compulsory, then there's a cost to every single employer. When it has to be insurance is a choice and an ethical choice for that business owner. It shouldn't be you have to do it.
Right, Lee.
Well, so from a selfish market opportunity perspective, yeah, it'd be great. I think the market will probably need at least 5 years' notice of it to ramp up in terms of the ability, first of all, to advise all of those companies, because I think of all the group risk products, Group IP does need some professional advice to guide people in the right direction, even if you put a bit of simplification in there. So I think the existing market is fairly well saturated in terms of business volumes, both from an advisory perspective and also a provider perspective. So, but in terms of the scale of the opportunity, it would be the one thing that made a real step change on the new business volumes. I think you take a step back for it and you recognise that probably making it compulsory might be one step too far, just simply because some organisations may have something else in place that not quite the same, but does
Make
the
it
job.
opt out like auto enrolment.
Yeah, but I think a strong government endorsement, as I mentioned earlier, would be a real positive step in the right direction, but with an ultimate ambition of making it compulsory. As Damien says, the government can't afford the NHS, it can't afford the welfare bill, so pushing a lot of that spend and support over to the private sector and to the employers is clearly the way it's going to go. It's probably just a question of how long. Probably won't happen in my lifetime, but maybe in one of these guys. But
I'm probably your age, but yeah. I mean, Australia, they talk about superannuation schemes, but they've got risk benefits attached to that, and that's compulsory. Right. I'm not sure I'd do full-term LTD or PHI or CHIP or whatever, but I mean, fixed term, some kind of starting point, and then you can opt up from there. Why not?
And in terms of, we've now got a situation, thanks to auto enrolment, where pretty much every employer in the country is digitally connected to providers one way or another, which is quite remarkable when you think where we were 5 years ago. Is there anything come down the line in the sort of big data of ways of using all of this data to make the life of intermediaries easier and providers able to access more people more efficiently?
yeah, so I think certainly one of the areas that we're keen to explore is accessing data from payroll, pension on a more direct basis, so you can feed it directly into our system, not with a view to cutting advisors out of the equation, but providing them more time to do consultancy, which is really where they earn their money. Don't generate much money by doing admin, as you highlighted earlier. So I think for us, in terms of accessing the 96% of companies that don't have any group risk cover, coming at it from a different route, getting direct access to data, and having the ability to maybe proactively push out quotes instead of hoping you're going to get some requests for quotes. That for us would be a bit of a game changer. So clearly I'm not going to talk here about all the detail that we're working on at the moment, but under our sort of areas of interest, that would certainly be high on the list.
Right.
Yep.
Okay, and then looking at EAPs and the value add-ons that come with products, I get a sense from providers, not necessarily Ellipse, but I get a sense from providers that maybe they feel that their take-up's not that great, and that's because potentially the intermediaries aren't embedding them well enough, doing enough work there. They may be selling the product then walking away, when actually the employer could be missing a trick on what they're getting some value out of the product. Do you think that's a fair challenge?
I think EAPs are a massive starting point for any holistic wellbeing program. I mean, if you fundamentally think of what they should be able to deliver, in terms of stress, concerns, financial debt, legal help, marital strife, they do offer a huge array of help, be it on the phone or face-to-face, whatever they may well be. I think the problem is that they are within a corporate organisation, stuck on the back of a toilet, and it devalues the meaning of them. I think actually companies that offer these things should be very proud of them and promote them heavily. Saying that, we're a financial organisation, we have EAPs, we have a health team, and I know certainly one of my own team has sadly just been in a kind of a bit of bother and didn't really even think about the EAP as the first point of connection, which is where I think we should be. So I'm a big fan. It's about using them properly. Utilise what you've got.
Malcolm.
Yeah, our advisors would always mention the EAPs that are associated to the various products, but I think it's the advisor and the insurance company together promoting that together. And I know that Ellipse do have a good onboarding process to promote a lot of their benefits that they've got. So it's a combined approach to really get the employer and the employees to understand the benefits they've got.
Yeah.
So to be fair, if you go back to the start, value-add services encompasses quite a broad range of added extras. So EAP is probably the common denominator that all the providers offer, and as the guys have outlined, that provides really valuable support. In terms of the other services, they vary quite a lot between generally things that encourage healthy living, support to help people when they go off sick, maybe access to a private GP service if they've got a 4-week waiting list at their own GP surgery. So those all potentially could add value in the right situations. I think one of the challenges is, so we put a lot of effort into describing those value adds, and all of that material is available on our website. In terms of what the advisors recommend to their clients and their criteria for placing business, and where those value add services feature in that recommendation, I would imagine is quite variable depending on who you're talking to. So in order for to increase the usage, the message has got to get from us to the advisors, from the advisors to the employer, which typically be the HR team, and then from the HR team onto the employees. And I think all I'd say is sometimes I suspect the communication breaks down somewhere in that chain.
I think the consultants are trying to add their value, and it actually detracts from the value that you've already put out there.
Yeah, and I'm pretty sure that some advisors have their own EAP or own value add, at which point, hang on, what are they recommending? Their own one, or the one that comes with the provider of the insurance. So you've almost got overlap.
Yeah, absolutely, that tension there. And and we've got one last question. Group risk development, of which you were the former chairman.
I was the chairman,
until a couple of months ago. Until the end of last year, sorry. Should it be more funded? Should providers be giving more into group risk, and also group risk development, and also should intermediaries be giving more into to the pot to grow the market and grow awareness of what the value of this most valuable set of benefits are?
So my views haven't changed since I've become ex-chair rather than when I was chair. So I'll give you the same answer now that I would have done in December. So I guess there's always a challenge around generic marketing and promotional activity versus specific to your business. And we as one of the smaller, one of the medium-sized providers in the modern world, our marketing budget is probably slightly more limited to some other organisations, and faced with a stark choice of do we spend the money on promoting Ellipse and our proposition versus should we just ring fence a lump of money and give it to the industry trade body, we would probably do the former. However, if everyone took that approach, you never really move the market on in terms of creating awareness. So there have been efforts in the past to generate marketing campaigns, industry funded. I think in principle it would be the right thing to do, and I think clearly GRID would be the right trade body to do that because it's focused purely on the group risk market. I think logistically within that group you'd have completely polarised views, some who'd say no, we're spending our marketing budget on our proposition, and you'd have others that would take a more big picture view and say, well, if we promote things from an industry level, then we'll benefit from more new business indirectly. And I think because of that wide range of views, it probably would never happen, because unless you can get everyone to sign up, it's going to be disproportionate in terms of the costs and the benefits. So.
Lee? Thank you.
I'd say it sits with the insurers.
Sorry, yeah.
I'd say it sits with the insurers. For us as the new to market intermediary, a lot of our cost is bringing new to market schemes into play. So for us, it very much sits with the insurers.
Right.
And I'd say you're having a laugh. In the nicest possible sense, I've got £1 million worth of cost embedded in my business, trying to do the government a favour by trying to engage corporations and organisations about well-being, and I think they're charging me more. No.
No. Okay, resounding no to that one then. Well, on that note, thank you all for watching. Thank you to my three panelists, and thank you all for watching.
Thank you.
Cheers, John.